Good morning, everyone. If you are watching this, you probably feel like you've been hit by a freight train. If you are holding silver, you definitely have. Today is Friday, February 13th, 2026. And while Friday the 13th is usually a superstition, for precious metals investors, the horror show is very, very real. We have just witnessed one of the most violent mechanical dislocations in the history of the silver market. Yesterday, silver crashed 12% in a single session. If we zoom out just a little bit, we are looking at a collapse of nearly 41% from the all-time highs we saw in late January. We saw the price break the psychological floor of $80 and then $76, triggering a liquidity event that wiped out billions in market capitalization in hours. Gold didn't escape either. It's down roughly 3% to 4%, hovering just under that critical $5,000 mark. Platinum is down. Copper is down. This is a bloodbath. But why? If you open the mainstream financial news this morning, they are going to tell you a very simple story. They will tell you it's because Donald Trump nominated Kevin Warsh as the next Fed chair. They will tell you it's because the US dollar is flexing its muscles again. I am here to tell you that is only 20% of the story. In this next hour, we are going to tear apart the market plumbing to show you what actually happened. We are going to look at how a $1.7 billion crypto liquidation event forced hedge funds to use silver as an ATM. We are going to look at how the Monroe Doctrine, Trump's aggressive geopolitical stance on Greenland, created a bond market panic that backfired on metals. And we are going to look at the CME Group, the exchange itself, changing the rules in the middle of the game by hiking margin requirements. We have a massive amount of ground to cover. We are going to look at the gamma squeeze that trapped dealers, the industrial demand that hasn't gone away, and the price targets from Bank of America that still point to $300 an ounce despite this crash. Grab your coffee or maybe something stronger. Let's dive into the wreckage. Let's start with the fundamental catalyst, the spark that lit the fuse. That spark is named Kevin Warsh. On January 30th, President Trump officially nominated Kevin Warsh to replace Jerome Powell as the next chairman of the Federal Reserve. Now, why does this matter so much? Because the market has a memory. Kevin Warsh is not a dove. He is not a money printer. Warsh is viewed by Wall Street as a hawk, someone who prioritizes a strong dollar and sound money over easy liquidity. His nomination sent a shockwave through the algorithm bots that run global macro trends. The logic is simple. If Warsh is in charge, rates stay higher for longer. If rates are high, the dollar gets stronger. And if the dollar gets stronger, dollar-denominated assets like silver and gold get hammered. This narrative was supercharged just days ago by the January jobs report. We saw 130,000 new non-farm payrolls added, smashing expectations. Unemployment dropped to 4.3%. According to CME Fed Watch tool a week ago, the market was pricing in a rate cut for March or June. Today, the market is pricing in a 94% chance that the Fed holds rates steady. The first cut has been pushed all the way back to July 2026. Real yields are rising. Silver yields nothing. It costs money to store it. When you can get a risk-free return on treasuries that is rising, the opportunity cost of holding silver goes up. That is the textbook economic explanation for why we sold off. But here is the catch. This fundamental repricing accounts for maybe a 3% or 4% drop. It does not explain a 12% intraday crash. It does not explain a 40% wipeout in 2 weeks. To understand that, we have to look at the mechanical failures. This is where the story gets interesting, and frankly, a little terrifying. We are living in an era of portfolio margin. Big hedge funds and institutional traders don't view silver in a vacuum. They have one big bucket of collateral. In that bucket, they have Bitcoin, they have Nvidia stocks, they have gold, and they have silver. On January 29 and into early February, Bitcoin fell from over $88,000 to below $85,000 in minutes. This triggered a $1.68 billion liquidation event in the crypto markets, the largest since the collapse of FTX. Here is the problem. When a hedge fund gets a margin call on their Bitcoin position, they have to come up with cash immediately. They can't sell their Bitcoin easily because the market is free-falling. So what do? They sell what is liquid. They sell what has a tight spread. They sell their winners. Silver was the winner. silver was sitting at all-time highs of $121. It was the house they had to sell to pay for the crashed Ferrari. Industry sources estimate that between $500 million and $1 billion of precious metals were sold not because investors hated silver, but because they needed to cover holes blown in their portfolios by crypto and tech stocks. This is what we call contagion. This created a feedback loop. As silver was sold to cover crypto losses, silver prices dropped. This triggered margin calls on the silver positions themselves. And then, the regulators stepped in. Between late January and this week, the CME Group, the exchange where futures are traded, raised the margin requirements. They hiked margins on silver from 11% to 15%. They hiked gold from 6% to 8%. Think about what that means. If you are a trader holding 100 contracts of silver, and suddenly the exchange says, you need to put up another $1.2 million in cash right now to keep this trade open, and you don't have the cash. You have no choice. You must sell. This wasn't a market making a decision about value. This was a forced liquidation event. It was a mechanical flush of leverage. Let's look at the charts because the technical damage here is significant. Yesterday, silver opened near $86. It looked like it might stabilize. And then the trapdoor opened. We saw a break below the $80 level. This was a crucial psychological support. Once that broke, the algorithms took over. We saw what's called stop-loss hunting. Trading bots pushed the price down to trigger the sell orders sitting just below support levels. The price stair-stepped down, $78, $76, hitting a low near $74.96 on the futures market. So, here is the multi-trillion-dollar question. Is the silver bull market dead? Let's look at the facts. Bear case. The chart is broken. We are trading below the 50-day moving average. The Warsh Fed is going to be hostile to zero-yield assets. The momentum traders have been flushed out, and they are scared to come back. Bull case. The structural deficit hasn't changed. According to the Silver Institute and Metals Focus, 2026 will be the sixth consecutive year of a market deficit. Global demand is forecast to outstrip supply by 67 million ounces this year. Industrial demand, specifically from the AI sector and solar, is exploding. AI data centers require massive amounts of electricity, and silver is the best conductor on Earth. Bank of America's Michael Widmer is still predicting this silver could hit $309 an ounce in 2026, based on historical gold-to-silver ratio compressions. Even J.P. Morgan, which is generally more conservative, sees an average price of $81 for the year. The gold-to-silver ratio is currently sitting around 61. In 2011, it went as low as 31. In 1980, it hit 14. If we are truly in a precious metals supercycle, silver is still historically cheap relative to gold, even after the rally and the crash. The fundamental reasons to own silver: fiscal dominance, the debt spiral, the industrial necessity of the metal for the green transition, those haven't changed. The only thing that changed is that the tourists who bought silver on 5x leverage because they thought they would get rich quick just got wiped out. If you are a long-term investor, you are looking at this $76 level. You are watching to see if $70 holds. If we hold $70, the structure is still intact. If we break $70, we could see a flush down to $55. My take? This is a buying opportunity for the brave. The industrial squeeze is coming. The mines aren't producing enough. And the Fed, regardless of who is in charge, cannot print silver. That is the breakdown of the 12% crash. I want to know what you are doing. Did you sell during the panic? Are you buying the dip? Do you trust the Warsh Fed? Let me know in the comments below. Do not forget to like and subscribe so you don't miss the next update, because with inflation data dropping later today, this volatility is far from over. I'm Sydney, and this has been your deep dive into the silver crash of 2026. Stay safe out there. Please like this video and subscribe to this channel.